Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So this symbiotic relationship, which is in black here, let me just start at the top. China is a global manufacturer, as we know, ships low-priced goods. The American consumer takes it as fast as he can, ships dollars back to China. China then takes those dollars and invests them where? As the major capital supplier back into the U.S. economy, which pushed suppressed U.S. interest rates and gave free credit to our investment bankers to create more derivatives and to the U.S. consumer so he could buy houses, all he wanted with subpar credit. They did that by buying U.S. Treasuries. So that recycling of these major FX reserves, because they didn't have a domestic economy to put them in, and they needed to keep their currency value in check, went back in the U.S. Treasuries, as I said, subsidized U.S. consumer, and spurred more consumer demand for what? Chinese goods. So it was a very, very nice symbiotic relationship all around. And as I said, the game changed right here when this thing called credit expansion right in the middle crumbled at something called the credit crunch. And all of a sudden this seamless cost of capital to China went away in a very, very big way and very, very fast. And what also went away was this guy right here called the U.S. consumer, because he realized that without the stock market going up, without his housing prices going up, his wealth was fading very, very fast. So he had to do something to build his wealth, and he started saving in a very, very big way. So what happens when the U.S. consumer starts saving? This stuff starts going in reverse, and to a degree, that's what we saw. No longer is China shipping a lot of goods over here, and no longer is the U.S. shipping a lot of dollars over there per se, and we're seeing that difference show up in the current account, which is right here. We're seeing a massive improvement in the U.S. current account because of this process going into reverse. So we have some pretty massive bubbles in China that had burst that are being rebuilt again. We had the property market starting to get into trouble. Their stock market got hammered in a very, very big way, if you remember. There's a lot of money locked up inside the system of China that creates this bubbles because a lot of consumers don't have the money to spend and move outside of China. They invest in their own asset markets, which drives up property prices and drives up their stock prices. They tend to be very big speculators in the stock market because there's no place else to put their money. They basically have forced savings in China. And again, that's a Chinese policy that has worked very, very well for China because it's built a lot of domestic pool of capital for their companies to increase their manufacturing power. So it's a definite policy, and that policy net in the end means they've overweighted their production and their export economy at the detriment of their consumer economy, and that's their choice. And you see it in this number right here. If you look at, if you can see this pen, sorry it's in yellow and you can't see this too well. Hopefully you can. Capital investment per GDP in China was 45% at the time. That's a massive amount of capital investment to GDP. So China, and the reason it is, they continue to build capacity because they want to grab share around the world. So it's a very, very simple game that they've been playing. And the reality is this game has come to a halt. And the major powers that be that have major investments in China, which is all of our major multinational corporations and a lot of private people that have real fixed asset investments in China, are very, very unhappy with this idea of global rebalancing. And they seem to be the ones driving policy here. And again, this is my call, nothing explicit here. Nobody told me this or said this, but if you look at what the U.S. is doing, they're trying to regenerate this relationship, it looks like to us. And the way to do that is the implicit weak dollar policy, again, the push down on the dollar by providing this massive amount of stimulus on the globe to try and regenerate U.S. consumer demand by pushing up asset prices first and foremost to lead to credit expansion. And if it does, if that happens, we are then back in that implicit weak dollar policy stage, which means the U.S. dollar then turns and runs down in a fairly controlled bear market to stimulate the global economy. So that's the first, I would say, Achilles heel that you would see in the U.S. dollar. And what you want to watch to see if this is starting to play out is really a change, again, in this trade pattern. If we see the current account deficit which has been improving in a big way, start to deteriorate again, and obviously the U.S. dollar would be part and parcel to that move. We know that this game is back on. So this is something we always continue to watch. So if this goes negative again because of the implicit weak dollar policy, IWDP, which we've used there, that fancy abbreviation, we think this game is back on. And it's a game that not only a lot of the U.S. multinationals would like to see, but a lot of the multinationals in other countries too, in Europe, who have major manufacturing bases in China. So there's a lot of vested interest to get this symbiotic relationship with the U.S. and China back in PO. Needless to say, Germany would love to see export demand improve because they're taking gas in a very, very big way. Being an export-dominated economy, their shipments to the U.S. are in trouble too. So as I said, there's a lot of vested interest here to see this stimulus play out and for a very weak dollar policy again. The second real Achilles heel for the dollar, and this is the scary one. This is the one where you pull the cover over your eyes type of scariness, because it would impact your wealth in a massive way if you don't have money offshore. And just the thought of this idea of the U.S. banana republic time in and of itself says to you, hey, I want to start putting money in gold as a hedge. I want to start putting money offshore as a hedge. Even the thought of this happening leads to sentiment, very negative sentiment for the dollar, and real people moving real money. And as I said, sadly, we're starting to see some shapes of this taking place because of the fact that the U.S. government has, and recently even more, is abusing its world reserve currency status in a very, very big way. This idea of world reserve currency status, what that means or understand why it's so important, let me just take a moment to describe that. The U.S. dollar really is different than any other currency in the world precisely because of this world reserve currency status. Any type of global trade that you do, you need to have dollars. All major commodities in the world are priced in dollars. So if you're a country and you're sitting out there, you need to always, and you want to trade with anybody and buy commodities, buy oil, those types of things, if you ever want to do any of that, and most countries need to because they don't always have a domestic source for all those commodity products, they therefore need to hold dollars. So if you think about that status the dollar has that is a major prop in a very, very big way. Countries have to hold dollars. They don't have to hold Australian dollars. They don't have to hold euro to a degree. They don't have to hold pounds. They don't necessarily have to hold yen. They have to hold the U.S. dollar to trade. That means you have a major support in a very, very big way. But with that advantage, when a country has that advantage, they're supposed to have some responsibility behind it in the same way. The U.S. has abused this status in a big way. It's given them a lot of financial and political muscle around the world because of this status. But as I said, they continue to abuse it because they're fiscally it's like, it's a Keystone Cops up there fiscally. Our government continues to grow and grow and grow, and this status is abused. No surprise why gold continues to inch a little bit higher and a little bit higher, a little bit higher, and lately it's come up in a very big way because of some things shaping up, and that's really what this section is about.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.